Welcome back. Now we'll turn our attention and the subject to notes receivable, the last part of Chapter 4. But first, I'd like you to test your memory about accounting for accounts receivable by answering the following questions, true or false. Uncollectible accounts receivable should be written off to bad debt expense only when it is known that a customer won't pay. Second, under the allowance method, net accounts receivable approximates the cash we will collect in the future and matches revenues with expenses. Third, the entry to record bad debt expense under the allowance method is debit bad debt expense and credit accounts receivable. Fourth, because it is an asset account, the allowance for doubtful accounts has a normal debit balance. And fifth, when we write off a customer's accounts receivable balance because it is uncollectible, there is no impact to either net accounts receivable or to net income. I will post the answers to these particular questions in D2L. Okay, so let's turn our attention to notes receivable. A frequent question that students ask is, what's the difference between an accounts receivable and a notes receivable? A promissory note is a written promise to pay a specific amount of money, usually plus interest, at a specific future date. The note illustrated on this slide shows a simple promissory note dated July 10, 2015 for $1,000 at 12% annual interest due in 90 days. Interest is the charge for using the money until its due date. To a borrower, interest is an expense, but to a lender, it is revenue. The note pictured is quite amusing to me because we rarely see one that is this simple. So I'm betting that the lawyers haven't seen this one yet. That being said, have you purchased a car lately? If you did, you'd probably came home with a pound or two of paperwork. This illustration is meant to show the critical components of the note for our accounting purposes. And the point is that notes receivable may be issued for many reasons. I've seen situations where the company loans money to the employees or to other businesses. The company sells expensive items for which the customer requires an extended payment period, like a car or furniture, for example. Or the company converts an existing accounts receivable to a note to allow for slower repayment. We see this in the homework. Now, the maturity date of a note is the day the lender receives its cash in the form of principal and interest. The period of a note is the time from the note's date to its maturity date. Many notes mature in less than a full year, and the period they cover is often expressed in number of days. The maturity date of the note is important because it determines how much interest must be paid to the lender. As a simple example, a 5-day note dated June 15 matures and is due on June 20. You never count the date the note is signed. The note starts accruing interest on June 16. June 16, 17, 18, 19, and 20 add up to 5 days. Now, let's assume TechCom made a $1,000 sale on July 10 to Julia Brown, who signed a 90-day note in return. The note bears interest at 12%. We need to calculate the maturity date, the date TechCom will receive its cash. When calculating the maturity date, we must use the actual number of days in each month. The maturity date is October 8, as shown on this slide and in the textbook. To determine this date, we start with the number of days in the month the note originated and subtract the date of the note. This gives the number of days in the originating month to count toward the maturity date. In our example, there were 31 days in July, but the note was signed on the 10th, so in July the note was outstanding for only 21 days. Then we add the number of days from the next 3 months until they add up to the note term. In this example, we would add 31 days in August, 30 days in September, and another 8 days in October to add up to the note term of 90 days. Interest is the cost of borrowing money for the borrower, or alternatively, the profit from lending money for the lender. The formula for computing interest on a note is principal times rate times time. Interest rates are normally stated for a year. We call that an annual interest rate. So multiplying the principal times rate gives us the interest for an entire year. We need to multiply by time to get the interest for a portion of the year the note was actually outstanding. Our textbook elects to use a year based on 360 days rather than 365 days. This is called the banker's rule in business and is commonly used in commercial transactions. And I've seen it used several times, including at the last company I worked for. Banks like it because it earns them more interest revenue, but it's also easier to use in interest calculations. And be careful with this. Using the promissory note in the earlier slide where we have a 90-day 12% $1,000 note, the total interest is computed at $30. To illustrate the recording of the receipt of a note, we use the $1,000 90-day 12% promissory note we discussed in the prior example. TechCom received this note at the time of a product sale to Julia Brown and recorded a debit to notes receivable and a credit to sales. The principal and interest of a note are due on its maturity date, in this case October 8th. At maturity, the maker of the note usually honors the note and pays it in full. TechCom receives cash of $1,030 in repayment of the original note amount of $1,000, plus they receive $30 of interest revenue. The balance in notes receivable is reduced to zero with a credit, and interest revenue is recorded with a credit of $30. Interest revenue, also called interest earned, is reported on the income statement. Now for a new scenario. When notes receivable are outstanding at the end of a period, any accrued interest earned is computed and recorded. On December 16, TechCom accepts a $3,000 60-day 12% note from a customer in granting an extension on a past due account. Let's assume TechCom needs to prepare a financial statement on December 31st. Time has passed between the issuance of the date on December 16 and the financial statement date of December 31st. However, the note won't be turned into cash for another few weeks, so TechCom must prepare an adjusting entry to accrue interest income on the note. In accrual basis accounting, remember that even though the cash isn't collected by December 31st, the interest revenue earned from December 16 to the 31st needs to be on the books. To prepare the entry, we need to first determine the amount of interest we need to record. Using the formula principal times rate times time, we determine that $15 worth of interest has accrued on this note by December 31st. The adjusting entry includes a debit to interest receivable, which is an asset, and a credit to interest revenue of $15. Continuing with our scenario, the maturity date of the note is February 14 of the next year. Have a close look at this entry recording the collection of the note by TechCom. Reverse the interest receivable of $15 recorded on December 31st and record the additional interest earned from January 1st to February 14 and reduce the note's receivable principal balance with a credit of $3,000. And you're all done, all paid up. Before we move on, though, notice that interest revenue is split into two periods. $15 is recognized prior to December 31st, and $45 is recognized in the next year. This is an important concept for you to study. The revenue recognition principle is in place here. TechCom earned revenue in both periods because it lent money during both periods. Like accounts receivable, notes receivable are assets and may be classified on the balance sheet as current, long-term, or both, depending upon when the note matures. Interest is usually earned for the entire period of the note. If a company needs cash soon, for any reason, they can sell their receivables or pledge them. Have a look in the book for the entries made when this occurs. Yes, there is a cost to doing this, and it can be rather expensive. In some industries, selling receivables is common practice. Certain financial statement disclosures are also required when this takes place. And finally, a little bit about evaluating receivables. The accounts receivable turnover ratio evaluates how efficient management has been in granting credit to produce revenue. For our purposes, average accounts receivable is determined by adding together the beginning accounts receivable balance and the ending accounts receivable balance and dividing this total by 2. This ratio measures how often, on average, receivables are received and collected during the period. If a company offers terms of net 30 days on their sales, then one would expect the turnover to be approximately once a month or 12 times per year. This ratio should be monitored closely by managers to compare the company's performance from period to period or with other companies in the similar industry. All done. I encourage you to give a little time each day to accounting. Cramming at the last minute is not productive because you will forget the information much faster than you think. We need to know and understand this to succeed in all accounting classes, but even more importantly, to succeed in your future career in business. See you online.